Let me now bring on board S. Ramesh, CFO with Lupin right now. Ramesh, good morning. Good to have you on ET Now. Thank you for joining us. Ramesh, let's start with the latest development. That is, Mylan has got approval to launch the generic version of Fortamet. How big is the market, and what kind of opportunity is this for you?
You'll be aware of the fact that we don't share product-wise revenues. Fortamet was indeed one of our products out there in the US market, but was not necessarily the mainstay. We have got more than 48 products out there in the US market. Another competitor coming in this case, Mylan, would not actually mean that there is going to be any derailment insofar as our overall program in the US markets are concerned. Whilst it is of course a negative development, it is not something that we can't contend with.
Right, so the management has indicated that they would like to acquire brands now going ahead and would be ready to spend close to $1 billion in doing the same. Give us a sense of what exactly are the regions and product types that will be part of this strategy, and has the company initiated talks with any player for the same?
We would not like to speculate on baseless rumors, but that said, a company of our size and stature would always be looking at actually acquiring if the value proposition is indeed going to be compelling. At any point of time, you would see, in fact, quite a few proposals on our table. That said, we've always been saying that we would be interested in looking at brands in America, or in fact, generic companies in countries like Russia, Latin America, and so on. If you look at our balance sheet, it is particularly under-leveraged today. The debt-equity ratio is tending to be lower than 0.2, and that you would appreciate is indeed a very low leverage. We easily can actually raise close to $1 billion, or perhaps a little more as well, but that does not necessarily mean that we'd be looking at an acquisition which is going to be that size. Potentially 3 or 4 bites of about $250 million would also be particularly attractive. That said, you can't put a deadline to it. This could happen over a period of time.
Ramesh, the company has a cash to the tune of about 500 crores on book, and are you looking at spending about 10 times on acquisitions? How do you plan to raise the balance? Is your balance sheet strong enough to support such a strong fundraising plans?
I've been saying exactly that. Our current cash holdings are close to about $120 million. And if you look at a debt-equity ratio, is currently about 0.2. You'd be able to leverage quite substantially on our existing balance sheet itself. Debt-equity ratio of 0.7, 0.8 could easily get us to, in fact, raising at least about $800 million. The debt-equity ratio of even 1 is not an end in itself. Obviously, with more accruals coming in, they would come down over a period of time. You'd appreciate it would be easily possible to raise at least 3 times the EBITDA of the company, and we are doing particularly high EBITDAs these days, about 1,600 crores. So easily raising about 4,000 crores on the balance sheet would not pose so much of a problem.
So what's the status with Antara, given that Mylan has launched the drug, and how much market share has the company lost? What would be the price reduction? One of the brokerage even says that the company will lose about $15 million annually on Mylan entry. Is that possible?
The way I would put it across is that the brands portfolio constitutes less than 25 to 30% of, in fact, our overall portfolio in America. So one brand going, going generic would not necessarily impact us tremendously. But that said, Antara is indeed one important product in our overall portfolio itself. But that said, if a brand which is born we could expect that to go generic at some point of time, and that's what has happened with Antara itself. In the short term, obviously, you'd be looking at, in fact, in-licensing more products into our portfolio, and perhaps looking at the medium term, you could be looking at 505(b)(2) launches from our own stable, which would actually take the brand's portfolio higher. But that said, Antara, I think we have not seen the end of it all, and there'll be more prospects coming in over a period of time on Antara itself.
Ramesh, so how is the company now looking at keeping growth momentum in the branded business, given that Antara will have a price erosion and there is a risk to the generic business of Suprex? Brokerages have already said that they see a 15 to 17% CAGR decline, not a one-time decline, but a CAGR decline in your branded business, which means your high margin business in coming quarters could be under threat.
Let me take it one question at a time. Insofar as Suprex is concerned, the going is still pretty strong. It's not as though we expect competition to hit Suprax immediately. Anybody actually wanting to get into Suprax would actually be making noises at the channel level, and we don't see that happening. So I would think for the next couple of years at least, we don't see any competition for Suprax itself. I told you sometime before, that insofar as the brand's portfolio is concerned, we would be looking at in-licensing newer brands into the portfolio in the short term. It could potentially be happening in the next few quarters itself. The medium to long-term prospects would indeed be actually coming in from our own stable, and that would actually mean those 505(b)(2)s that we are working on, and potentially the new chemical entities that we are working on itself for the very long term.
Right, so let's talk about the niche pipeline for FY14. Cipro, Fosrenol, you've got Loestrin as well. They will all hit the markets. What kind of revenue potential will these drugs have for the company?
You would very well know that we don't talk about product-wise revenues, but you have actually mentioned a few and which could potentially be launched during the course of the next year. You would also be aware of the fact that we had made close to about 28, 29 submissions on the oral contraceptives front. We expect a few of those to be launched in the current fiscal itself, but unfortunately these were delayed. We expect some of those to actually get approvals during the course of the next year, and so you would find in fact a lot of those being launched next year. And potentially even the Oftal portfolio that we filed a few months ago, in fact quite a few quarters ago, would also be hitting, we will be starting to launch those again in the US market. If you look at in fact our growth rate in America in the past, it's been well over 20-25%. And if you look at the richness of our pipeline for the future as well, we're fairly confident, in fact very confident, that we'll be able to sustain a growth rate of well over 20%, 25% in the line of sight of about 2 to 3 years.
Ramesh, the third quarter somehow was weak as far as domestic markets were concerned. How do you see growth panning out for Lupin's domestic market in the coming quarters?
The domestic industry, follows the patterns of the GDP itself. The healthcare sector in India generally grows at twice the pace of the GDP itself. And you know that the GDP of late has been, in fact, exhibiting some slowdown symptoms. But we expect that to pick up the quarters to come, and potentially next year or the year next, perhaps we could be back to the 7.5% growth rates. So you would expect the healthcare sector to grow at around 14 to 15%, and that includes the pharmaceutical sector. We have been growing at well over 1.5 times that, so we would be hitting again the 20-22% growth rate. The last few quarters, in fact, it's not been a bad run. It's been pretty okay at 18-19%. We would expect the momentum to pick up in the next few quarters.
So Ramesh, post the launch, can you give us an indication of the performance of Tricor?
Tricor has been a pretty good hit insofar as we are concerned. It was a drug which was selling about $1.2 billion in the market. In fact, it was a delayed launch by, in fact, Teva itself, and we launched immediately, in fact, a few weeks after Teva. We've done particularly well in terms of overall market share is concerned. The price erosion was not so much really, so we've been able to do particularly well in Tricor, and that sustained during the course of this quarter as well.
Ramesh, how is the Japanese market playing out for the company, and what kind of growth we could expect to hear from you when it comes to Japan, because Japan is not a small market, it is world's third biggest generic market.
The Japanese generic industry has been growing at around 10% in the last few quarters. The overall genericization rate in Japan is still pretty low. The government has been giving a lot of incentives to the trade as well as to doctors to take the market genericization rate to close to 30%. It's currently about 25%. Perhaps in the short term, which is in the next couple of years, you would see that hitting the 30% mark. But in the medium term, the government's goal is to take it to 60%. So that said, we would expect, in fact, pretty good growth rates in Japan. Our bolt-on acquisition in terms of IROM is certainly going to help us, because it helps us to get into the DPC / injectable space. Our own growth rate in Japan in the last few quarters has been 15-16%. We expect that to sustain.
Right, so how do you see the year ending for Lupin in terms of top line, bottom line, as well as margins?
Pretty good. The last 9 months were kind of indicative what we could, have been pretty good, and that's kind of indicative what we could achieve in the fourth quarter also.
Okay, Ramesh, good chatting with you. Appreciate you taking the time out and joining us.